Good afternoon. Welcome to this ACT webinar on counterparty risk and particularly on monitoring your bank. We're grateful to S&P Capital IQ for making possible today's event. If you need technical help about the webinar with sound or with seeing the slides, you can click the red Live Event Tech Support button on the right below the media window. Also below the media window, but on the left, is the Ask a Question box. If you have questions for the speakers, you can ask them at any time during the webinar, and we'll refer to them during the session at the end. If you accidentally put Event Tech Support questions in the question box, don't worry, as the support team will notice them and will fish them out to deal with. So, we have on the agenda a presentation by Matthew McKee from S&P Capital IQ, and then Scott Tricker from Diageo will briefly give a corporate risk management view, and then we'll get into the discussion and onto questions. To repeat, you can ask at any time through the Ask a Question box on the left below the media window. And finally, the webinar will be on the ACT website in a couple of days when we receive the recording, and we'll let you know with an email. So, I'm John Grout. I'm Policy and Technical Director of the ACT. And what are we about? We are the giving direction part of the ACT's activities, which are listed here. Okay. And today, as you know, we're going to be looking at monitoring your bank spotlight on counterparty risks. So the ACT provides a number of ways for you to keep up, which Policy and Technical exploits, ranging from the Treasurer magazine to following me on Twitter. You'll be able to note those links in the recording when you wish. So banks. Now, banks are important to non-financial corporates as lenders and in a number of other ways as well. So it's not just an exposure to them as investors when we've made deposits or hold their CDs and so on. We take a great interest in banks' credit standings. Treasurers have all been brought up to consider this, and probably before the financial crisis we did that a bit formulaically. We took comfort from the too big to fail doctrine following the collapse of continental Illinois in 1984. And then came the Lehman shock. Post-crisis, no more too big to fail, perhaps. And what about smaller banks like we saw in Cyprus? Anyway, we do touch on bank counterparty risk in two ACT guidance notes, which are on the website. They have some good general advice, and they advise looking at supplementing credit ratings with other inputs and information services, including those from various analytical firms. I should quickly say, by the way, that it's just as embarrassing when your bank that is lending to you goes bust as part of a syndicated loan or directly, as it is if you've got cash deposited with them. Well, maybe not quite so. But certainly we had Franklin National as a member of a syndicate in the 1980s, and it took us a long time to sort that mess out. So that's another reason for looking beyond credit ratings, which tend to be of a slightly long-term view, at something more immediate. Various analytical firms provide inputs for that purpose, and one of them obviously would be S&P Capital IQ. So, over to you, Matthew.
Thanks very much, John, and thank you to you on the line for dialing in. I actually have quite a lot to get through today in the time I've been given, so I'll try and go at a suitable rate of knots and not to lose you along the way. I'm going to start by giving an overview of who we are at S&P Capital IQ, and the bulk of my presentation will be running through our recommended framework for analysing bank counterparties. Along the way, I'll touch on banking system risk, and I'll also be adding in a few slides talking about some case studies that we've put together for banking systems in Western European countries. So this is an overview of who we are at S&P Capital IQ and how we fit together under McGraw-Hill Financial. You see on the left-hand side we have Standard & Poor's Rating Services. Now we sit on the other side of that red separation of business line, and we are analytically independent and separate from the ratings agency, but we do benefit from their long history and experience in financial markets, and also some of their analytical outputs as well. So this slide is for context, really. It's a simplified web of how a corporate interacts with financial institutions. The important thing to have in mind is cash flow. So in the middle we have a parent company based in the UK, cash going out to supplier based in Ukraine, perhaps cash piling up in a subsidiary in Ireland, and then revenues coming in the domestic market. In reality, of course, there'd be more suppliers and more clients, and it'd be a lot more complicated. This is just generally to help us consider the important things, how much money to keep and where to keep it, what are the tax implications, are we being efficient, think about rate of return. And then obviously today we're concerned with credit risk. And one thing to be mindful of here is if your supplier is in Ukraine and they deal with a bank which is perhaps a subsidiary of a large financial institution like someone like Citibank, say, they do not have the same credit strength as that bank has in its home market. So that's quite important to bear in mind. And this is a little bit more context just to help make that distinction in your minds about S&P ratings and S&P Capital IQ. So that small grey circle, that's the realm of the ratings agency. They have a wealth of information with which they can make ratings on about 6,500 banks and some 3,500 corporations. S&P Capital IQ, our solutions have been designed to help across the whole counterparty universe. So we don't have quite as much information, but we are able to expand the coverage by a considerable margin. So I'll go through the framework now. And this is a recommendation that we've established from conversations that we've had with our clients, and they are a collection of best practices that we've observed. I think in the interest of time, I won't go through these steps here, but that will become apparent as we go through. Just note that the essential ingredient is fundamental data, and you can't really do this kind of analysis without up-to-date and accurate financial statements. So this is the first step, and it's to analyze banking systems. So we suggest doing this by looking at S&P Capital IQ's banking industry country risk scores. Now, the ratings agency produce a banking industry country risk assessment, or BICRA. This is based on economic risk factors and industry risk factors. BICRAs are produced for any banking system where an individual bank is rated. And on the left-hand side, you can see that there's a summary of the current UK BICRA. It's scaled from 1 to 10, with 1 being the strongest. So you can see the economic risk, well, you probably have to have quite good eyesight to see that the economic risk is 4, industry risk is 3, and the total BICRA score is 3. Now, S&P Capital IQ has a methodology that extends this BICRA to include countries where there are no individually rated banks. And it produces a letter grade score to distinguish itself from BICRA. From this point on in the presentation, I'm only going to be referring to banking industry country risk scores and not the BICRA, which is produced by S&P Ratings. So as far as this step is concerned, the scores help to analyze countries on an individual basis, and it's not a great leap to realize that you can also do that on a comparative basis as well. And it's quite a comprehensive analysis, but it's also quite quick because the analysis has already been done for you. And that frees up some of your time to think a little bit more strategically. You might think about geographic concentrations. In the table we have a mock portfolio of bank counterparties, and I've highlighted the box in the bottom right. A lot of countries where the dollar percentage exposure is in single digits, and they have quite poor banking industry country risk scores. If you group them together, you'll see that quite a lot of that exposure, over a fifth, is doesn't have the highest bank industry country risk score, so that's something to be mindful of. Another thing to be mindful of, which I'll address in this slide, is the fact that there's a distinction to be made between sovereign risk and banking risk. So 2 out of the 3 economic risk factors that go into the banking industry country risk score are used in putting together a sovereign rating. But the industry risk component, which relates to the banking regulatory environment in a country, is not included in a sovereign rating. So a sovereign rating shouldn't be used as a proxy for banking system risk. That would be inaccurate. These countries here have been included as examples where there is considerable divergence between the 2 measures. I won't go through it all, but we look at China at the top. The sovereign rating is AA-, and you can see that the banking industry country risk score is BBB-. So that's quite a disparity between the 2. So it's important to make sure that the measurement you're using is being used in the way that it was intended. So moving on to step 2, we suggest broadening the analysis and within the banking system looking at individual counterparties. An obvious first stop is looking at those banks that you have dealings with. The work can be quite time-consuming. A big advantage is having the tools to look at both banks that you're exposed to and banks that you're not exposed to. This way you can make sure that you've got a complete picture. So to continue with this illustrative example, we have France and Italy. You can see there's a handful of rated banks that they're exposed to. And if we use quantitative models and fundamental data, we're able to broaden the analysis to the point where we have a view on many more banks. And this puts you in a position where you're able to anticipate and respond more quickly to events. So if we say your counterparty in Ukraine requests dealing with a new bank, you'll be in a position where you already have performed your analysis, so you already have a view on the bank in question, and you won't be caught out. So still on step 2 here, this is a slightly different view. We've taken a sample of 200 Western European banks. Of that 200, 61 were rated by Standard & Poor's. So you can see that chart in the top left, the range of credit strengths in the UK in particular is quite broad. It ranges just left of centre, the red line you can see from AAA down to BB+. In order to broaden the analysis, we fed fundamental data for the 200 Western European banks through our credit model. And this gives a quantitative measure of standalone credit strength. And this analysis was quite straightforward to put together, and it provides a snapshot of what to expect when looking at bank counterparties in specific countries. A broader dispersion, as shown in Ireland and Italy, tells you that you need to be more prudent when selecting a bank counterparty in those jurisdictions, whereas with Norway and the Netherlands, there's a narrow dispersion, so you can have a little bit more confidence in the counterparties based there. Still on step 2, this is the same approach but just done on a country level. So of those Norwegian banks in the sample, only 4 had credit ratings. Using credit model, we were able to increase the number of banks that we have visibility on to 35, or to include 35 further banks. And then similarly with Switzerland, 32 more banks can be assessed using credit model. Now the same industry and economic factors used in the banking industry country risk scores are used to create the credit model score. And what you'll find is that the clusters in the charts, so Norway, the blue bars are clustered around BBB+, and Switzerland is around single A. Now that will be very close to what the banking industry country risk scores are for those 2 countries in question. And we've actually established in other presentations that 75% of standard standalone credit profiles fall within 2 notches of the banking industry country risk scores. So steps 1 and 2 focus on point-in-time analysis. Step 3 explores trend analysis. It's prudent to perform retrospective trend analysis, as well as scenario analysis for individual banks or indeed a whole banking systems. You might want to ask, is the banking system that you're assessing in an upturn or a downturn? How does it respond to stress testing? What happens if you reduce certain financials by a 10% figure? And in doing this, you can determine which banks are most resilient and which have the most headroom, I guess, in terms of credit quality. So this is an example of some trend analysis. I'll be the first to admit that it's not the most aesthetically pleasing chart I've ever included in a presentation. It's 1-year fundamental probability of default for a sample of banks across Western Europe. If you look at the black dotted line, that's the 1-year fundamental PD for the whole sample of Western European banks. It's been steadily trending down over the last 5 years, from 2% down to around 1%. And I guess the point I'd make here is that once you know what the region is doing as a whole, you can then identify underperforming or overperforming banking systems. So the first 3 steps give you your platform, your medium to long-term view on counterparty credit. You probably want to review that on a yearly or maybe a half-yearly basis. The final step is to monitor the risk using short-term measurements like CDS and market-derived signals, as shown here by the yellow lines in the chart. So the blue line is the credit rating, and as John mentioned, this is a longer-term measure of credit risk. The yellow line shows market sentiment, and it can be viewed on a daily basis. So this is ideal for short-term monitoring. You're not relying on financial statements, so you don't have to wait for a whole quarter to pass before you get a revised view. And this is another example of a short-term measure. It's market signal probability of default before the default of a Cypriot bank. If you look at the chart, you can see that normal activity up until around February of 2012 is below the 2% mark. And then at that point, there is quite a big spike up to 8%. So what you would take from this is that the PD never returns to a normal level of activity. You might want to wait for a correction, but it doesn't come. And from the time that the spike happened until the time of the default, you want to be thinking about monitoring this counterparty more closely, perhaps implementing whatever plan you have in place, and maybe shrinking your exposure. So that was pretty much all I have to say. It's quite a lot of information. I hope you've been able to take it in. And I'm going to hand over now to Scott.
Thanks, Matt. And I think I firstly have to commend the ACT for putting a seminar on counterparty risk on a day when we stand on the brink of something quite significant coming out of the US. So very good timing. I guess for the next sort of 10 minutes or so, I just wanted to give some perspective on, our approach as a corporate and some of the considerations that we have around counterparty risk, and then talk a little bit more around, some of the future challenges and opportunities, in this area. Building actually on what Matt has just covered off. Firstly, a little bit of background around Diageo for those who are not familiar with us as a company. Diageo is the world's leading premium drinks company. We were formed around 15 years ago following the merger of Grand Metropolitan and Guinness. We've got sales just over 11 billion sterling and operating profit around 3.5 billion. Principally listed in New York and London, around 36,000 employees. key subsidiaries in 80+ countries, and as you see, kind of 160+ brands sold in most countries around the world. And I hope that many of you on the call, will know and enjoy some of our key brands: Johnny Walker, Smirnoff, Guinness, Captain Morgan, to name a few. So a little bit around the company. In terms of our considerations around counterparty risk, clearly today we're focused on banking partners, but I did just want to touch on what I see as perhaps a trend coming through corporately, and that is to say a greater involvement of Treasury on counterparty risk in its wider forms, not just the kind of traditional focus on banks, but also insurers, certainly customers, and increasingly kind of suppliers and really anyone in between, that whole end-to-end chain. For me, the linkages are obvious when we kind of think around how this ties to the purpose of our Treasury team, which is around exemplary financing and risk management, with the latter clearly of great importance in the last few years with the world economic challenges, which, as I just said, are very much still with us. I do see crossover in approaches to determining risk frameworks and assessments for banks, through the insurers, customers, and suppliers. There's a clear linkage in approach. But turning specifically to our banking partners, I think it's important, and certainly for us, to be clear on the appetite for risk, driven from the top, and then tolerance thresholds, and really the aim of counterparty risk assessment for us as a corporate. For me, it's around kind of avoiding material loss to the group, from delay or default from whichever counterparty that might arise in. Clearly, appetites and tolerance will vary depending on each company's circumstances, private or public, investor sentiment of the stock, size, scale, complexity, etc. Although few, I would argue, would willingly accept losses from counterparties. So the appetite tends to be, I think, rightly very narrow. Our overall aim is very much to minimise financial credit risk through the application of our risk management policies, approved and monitored by the board. In the first instance, counterparties are limited to major banks and financial institutions for us. Primarily, we look to partner with banks and partners who have a long-term credit rating in the A band or better, and we look to restrict our exposure to any one counterparty. The policies that we have are designed really to ensure individual limits are adhered to, and there are no significant concentrations of credit risk in the business. At Diageo, we have a range of tools and processes that we use to assess, monitor, and react to counterparty risk, reflective of the varying instruments that carry risk, as kind of John alluded to at the beginning. And if we take the overall aim that I touched on, we have a statement of authority which outlines the parameters within which we can operate. That's reviewed annually. Also reviewed at least annually is the credit limit for each of our banks, both global relationship banks and local partner banks. For the global banks in particular, this involves a really detailed assessment, weighting in factors including capitalization, asset quality, kind of qualitative review around management strategy, exposure to certain markets, stability of earnings and diversity, liquidity, which would include kind of CDS, asset liability management, and then kind of credit ratings. Each factor has a kind of number of metrics against which an overall score is obtained, and then the weighting of that overall score then further builds into an overall assessment. And this methodology was actually further enhanced for us last year by utilising an externally developed tool to model the probability of default. And the calculation for that takes into account the market price of equity of the bank in calculating the likelihood of insolvency. And we believe provides us with a more timely indication of declining credit quality. In this regard, we're able to run that assessment at any point in time. So, building on Matt's point, getting more towards kind of live, shorter-term monitoring. As standard, on a daily basis, Treasury tracks the credit exposure versus the policy limits, and then at least weekly we'll monitor the kind of market perception of credit worthiness via CDS, but also the probability of default model that I mentioned. We then will place banks on full, limited, or no trading, depending on the assessment, and where they are versus either the actual financial limits or the risk limits that have been breached. And during periods of kind of financial stress, we will increase that monitoring, in particular looking at some of the short-term monitoring tools like CDS, and then changes are reported and agreed upwards as required. Our main exposures rest with our global relationship banks, but we also have exposure to locally operating banks around the world, and these two are subject to a set authority thresholds. In particular, we approve an overall level of exposure globally for the group on non-relationship banks, and then we'll look to within that set approvals for any one individual limit. Again, monitoring is provided through Treasury, supported by our IS platforms. And that probably neatly brings me to the future and challenges, opportunities that we see. We've sought, where possible, to reduce or eliminate the use of certain non-relationship banks. But as we grow in emerging markets, certainly for Treasury, that's true. We often acquire historic local relationships, and in a number of markets, global banks simply can't always provide the full suite of services and products that we require, and therefore determining the right balance on exposure versus operating efficiency is really key for us. For this, we've turned again to the assessment tools that we have, in particular the probability of default tool. But the big challenge, I think, on a number of non-relationship global banks is the data challenge. That being, there being limited data, often no ratings, and so, running the models as we have developed them becomes that much more difficult, and reliance on them is sometimes difficult. As we build history and the markets open up, I'm sure that will help, but for now we kind of take a prudent approach based on the needs of the business and also balancing that against the risk that we see. In terms of next steps for us, increasingly we're looking to move to as much of a live, real-time assessment as we can. The world moves fast. We need to be agile and move with it, not just on risk, but from capturing business opportunities as well. Enhancing our probability of default tools, I see as key. Getting clarity of the best indicators of the macro risk is also important. And I think really just trying to keep some of those simple. We hear the term analysis paralysis often, and I think just finding the right tools that can work for the business, is key. Scenario-based planning or stress testing is also important. We've spent time through our risk management committee considering areas like Euro risk, and then we've expanded that towards higher risk territories from a potential kind of financial crisis, and then setting some incident crisis management plans around those and items to consider almost pre-plan for or react to in the event of that crisis happening. So not trying to predict everything, but just having almost a suite of tools available that can support the business. So in summary, I think there are clearly many ways to approach counterparty risk. We have one route. Clearly each corporate needs to find its own. I think the final message I'd leave is that I really see the interconnectivity of risk and the pace of change becoming greater and faster, and therefore, we need to adapt our tools and processes to meet those challenges. And with that, I think I will hand back for Q&A.
Thank you very much, Scott, and thank you, Matthew, as well for earlier. So before we get into questions, by the way, do please keep them coming in that box on the left below the media pane. Has Matthew and Scott, has anything which the other of you said prompted you to want to make any kind of comment or ask a question that, as obviously this is the first time you've heard each other's what you have to say. Is there anything you want to actually raise?
I'd maybe make one comment. I mean, I think I was quite interested in the the review around banks that we are exposed to and those that we aren't. I think that's actually a very key point actually, and partly driven by time, partly driven by data and where you have to go to get that data. I think the focus can often be on those banks that we partner with directly, but clearly getting a comparison and also to the agility point that I was mentioning, being prepared for other banks that we may partner with in the future, I think is a really good point. So that bit in particular kind of prompted some thoughts in my head. Yeah.
And I mean, to that, I guess I would say with Scott's summary that I went through a lot of different things and different tools, and it's quite in depth. But I think it is a key point that you have to find what works for you, what you're comfortable using, and if you think that gives you a suitable level of analysis for your company, then I guess that's quite an important thing as well.
Yeah, do what you're comfortable with, but make sure you're comfortable with enough. Yeah, Matthew, then, the first question that we have coming in, just when getting the credit model scores that you were talking about, what financial data do you need to have? I mean, how do you do that?
So in terms of the inputs?
I think that's what it's about.
So yeah, if somebody's using credit model, you can actually use it for getting scores on corporates as well. With corporates, you would use about 10 inputs, like the main suspects from financial statements and then some liquidity factors as well. If you're looking at assessing a bank, it would be a little bit more detail, probably about, I think maybe 16 inputs around that mark. If you have all of the inputs there, then obviously your output is going to be more reliable. If you're confident that your data is accurate. If you do have a few blanks, what the credit model will do is find the most likely accurate data point based on other companies with similar financials that are in our database.
That's good, thank you. So Scott, how does Diageo, this question, set the monetary amount of its limit for a given institution? You've talked about the generalities.
Sure.
Reduce it to numbers for us.
Sure, yeah. And I think you start from need. So, we clearly look to understand what our need is and what our kind of overall utilization is. And then, we go through, we have, certainly from a global perspective, we have a set number of, global relationship partner banks. And so we will then go through that process that I described and that methodology in, effectively determining a relative ranking between those banks. And then, based on the overall number that we have, we'll then look to allocate, nominally between those partner banks, always overlaying kind of, again, the need and the usage that we have for each particular bank. We will also look to separate out what I would call a treasury limit versus an in-market or a local business limit. So we'll split an overall number between that, again, taking into account what the relative strength and usages are of each bank. So essentially, we will determine numbers that drop out of that assessment. And
do you find that you're doing a large transaction and that blows all the limits you've got if you're doing a merger and acquisition type transaction or something? Does that happen? How do you cope with that?
Yeah, I mean, I think, again, I think you have to separate, kind of smaller transactions from more material ones. And again, look at thresholds that you have. But clearly, if there is something more significant, then you may need to go back and get separate approval for, temporary limit increase or even a permanent one if that is going to, permanently shift the needle in terms of requirement. So again, it's coming back to need. I think sometimes when when you bring businesses in, there's a synergy point to usage, and therefore understanding what that will be, I think, is important as well. But certainly, it can mean a challenge on the limits as we as we get into those deals. Yeah.
Good. Thank you. So Matthew, you mentioned probability of default.
Yes.
And the question has come in saying, what is probability of default? And then another on probability of default for you, Scott, after that, is that your tools and processes looked at particularly at probability of default. But do you look at loss given default? What do you do on that? So
I'll take the first part. Yeah. The PD that I used in the presentation is an assessment of credit risk that's produced with an S&P Capital IQ model called PD Fundamentals, and this produces a medium to longer term assessment of credit risk that's reflected in both a numerical probability of default as well as a small cap letter grade score in the AAA to CCC scale.
Yeah, and I think from our side, two measures I think that we would look at in particular. CDS we talked on, and I guess we would all kind of understand the probability of default model that we have. As I say, kind of looks at the market price of equity of the bank in calculating the likelihood of insolvency. What the model does is effectively give a number that looks very similar to a kind of CDS figure, and so kind of comparison across is possible. So really, we look to have something that enhances the kind of CDS approach, but we think gives a kind of a maybe a different perspective and something to enhance that view. So really we look at the tools in combination rather than just one in isolation.
Thank you. Another question that sort of goes to both of you. Matthew, you talked about the S&P scores distinguishing between the levels of short-term risk, which is particularly, you dwelt on S&P Capital IQ for that, and longer term, which is the more normal credit rating from your colleagues. How in the long run it may look fine, but we don't want to die in the short term. I mean, how does that get balanced?
Well, I think that's partly why we put the framework together in the way that we have. It's obviously important to have a well-established long-term view, and you do your in-depth analysis. But I think that what we've all experienced recently with the world is sometimes things can shock you and catch you off guard. And the step 4 of the framework is aimed at making sure that you aren't caught off guard by only relying on the long-term metrics. I mean, the long-term metrics obviously still very valid, but they are designed to be long-term measures of credit risk. So you need to kind of complement that with some more short-term factors that bring in market sentiment.
Yeah, and I'll maybe add to that. I mean, I think you have to react to the world around you, and long-term assessments are, as Matt says, valid, are good. They'll also give you good comparisons and be able to give you some stability in how you assess your counterparties. But really, the short-term assessments and kind of analysis gives you that agility and flexibility, I think, to again react to the world that's happening all around us. And so for me, you can't have one without the other. But certainly, and over the last, I guess, 5 years or so, the short-term assessment, I think, has absolutely grown in importance for certainly for us in terms of having those right assessments in place.
Thank you. Let's move on a bit to CDS spreads, because they were referred to, Matthew, in your discussion. We have 2 questions come in that relate to those. The first one says, where do you get the CDS spreads from? How reliable are they?
Mm-hmm.
And then how do you deal with counterparties for which there are no single-party CDSs available? Or is that just a hole?
So the CDS feeds into that market-derived signal, which was in one of the later stages of the framework. It is a shortcoming of it as a usable short-term measuring technique. The coverage isn't great. It's only applicable where you have CDS. There are other short-term measures you can use, and some of the probability of default models are aimed more of a short-term basis. So that would probably be my first suggestion if you are lacking in CDS, to use another short-term measure.
Yeah, I mean, it's the lack of CDS is an issue that comes up for us. Certainly when we're talking on a number of the kind of local banks, and our framework for non-relationship banks effectively takes into account whether there is no CDS or a CDS that is over a certain threshold, and will therefore give a tolerance for the local market within that. It's a very, very small number. And then above that, I think if you want to use them in a larger way, there has to be some more assessment, and that's where we come back to. So again, it's coming back to what do you need that partner for, and therefore what time do you need to invest in just understanding where they sit from a counterparty perspective.
But as a company, do you monitor market signals like, I don't know, share price of bonds, so on and so forth of your counterparties?
Yeah, I think some of those factors are in our regular reviews. Our shorter-term assessments tend to focus more around CDS and probability of default models. But again, kind of reacting to the world that's around, we will take on board some macro signals that we get from various sources actually. So again, we try not to be overloaded with models and assessments, but we will absorb kind of news, and also particularly on the non-relationship banks, the local business is integral to that assessment as well. So they are part of that assessment and knowledge. So we try and build out the portfolio of knowledge, I guess, on that. So we'll factor it in, but we focus more on the CDS and probability of default.
And how fast do you respond if you suddenly see a signal a downgrade in rating, which may be quite a late signal, or a steady fall in a counterparty's bond prices? How do you respond? How do you decide when to respond?
Sure. I mean, I think again, it comes back to the framework that we have, the thresholds that we have at certain risk levels. So if they breach one of those, there's a clearly defined action that we would take. If we see something trending, we will generally pick that up through at least our weekly meetings where we analyse and look at what's happening in the market. If not the daily review that we would have in times of more financial stress. So I think regular review and then applying that into kind of predefined actions, predefined thresholds is the approach that we take.
Yeah, and Matthew, given the complexity of banks and that you've got the parent and you've got operating subsidiaries in some countries, branches and so forth, how does your output distinguish between all of those different things?
So when I talked about the credit model scores, they are standalone measures, so that doesn't factor in the parental or governmental support.
So it relates to the particular subsidiary or the particular...
So, I mean, I guess the aim of credit model is to give you a broader view, and if you think back to the circle I showed at the beginning, we're looking in areas where you don't have as much accuracy of information, so you're trying to give yourself a degree of visibility where you perhaps have none.
So if I was dealing with a foreign bank subsidiary in London, would that be in your universe, or would it only be the bank itself?
Well, just to kind of finish the point, the credit model score is, like I said, a standalone measure, and if it were being assessed by Standard & Poor's ratings agency, they would then provide a qualitative overlay on the fundamental analysis that they've already done. So the credit model score doesn't have any qualitative overlay.
So you don't factor in something for parent support?
No, so it's quite clear that it's just a standalone measure. It doesn't have any parental or governmental support. So it could be, that's why you get a discrepancy in terms of a couple of notches away from what a rating would be from the ratings agency, because they provide that qualitative overlay.
Right. So there's a further richness of the information in those different...
Yeah, I think, like I said, you have to think back to that chart where in the middle the rating agency have a wealth of information, and then we're trying to just say it's not always possible to have a huge wealth of information available, so you can have something that's better than nothing.
Very good. Okay, well, thank you very much. We've run out of time for that at that point. I have a couple of things which I have to say about the mechanics of how you get the recording of this seminar. If you want to go over anything again or share it with others, the recording will be put up on the ACT website in the next couple of days, and we'll send you a link by email, and a link also to a short feedback survey, which we'd be grateful if you take a moment to complete. So it remains for me to thank our sponsors S&P IQ Capital and our speakers Matthew and Scott, and all of you and those who've submitted questions, to say that I hope you'll be able to join the next ACT seminar on the 30th of October on SEPA, Realising the Long-Term Benefits. Thank you to all who's participated, and goodbye for now.